Right now, as this video is being recorded, the Middle East is on fire. Explosions are lighting up the skies over Iran. Multiple military facilities have reportedly been struck. Air defenses are active. Regional embassies are on emergency protocols. This is not speculation. This is not a rumor. This is happening in real time. And while the world is glued to missile footage and breaking news alerts, something else is happening. Something even bigger. The financial system is reacting before the headlines fully catch up. Gold is exploding. Silver is breaking pricing models. And physical markets are separating from paper markets in ways that almost nobody is prepared for. This is not just a geopolitical event. This is a financial inflection point. Welcome back to The Hidden Economy, where we connect the dots the mainstream media ignores. And what's unfolding right now could redefine precious metals pricing for years. The weekend shock. Here's what makes this moment so unusual. Traditional futures exchanges are closed. COMEX is offline. London bullion markets are offline. Major trading desks are dark. But digital gold, tokenized gold trading 24/7, has already surged sharply above Friday's close. That tells you something critical. When markets are closed and price still moves aggressively higher on the only open venues, that's not retail panic. That's institutional repositioning. That's smart money front-running risk. And the move isn't small. We're talking about a massive weekend gap forming before the official opening bell. Now ask yourself, if price is already moving this much with most liquidity offline, what happens when global markets reopen and trillions of dollars can reposition at once? That's the setup forming right now. Silver is sending an even bigger signal. Gold gets headlines. Silver sends warnings. Across Asia, especially inside major Chinese physical trading hubs, premiums on physical silver have surged dramatically. The international spot price might show one number, but the physical buyback price, what dealers are actually paying for real metal in hand, is significantly higher. That spread matters, because when physical demand detaches from futures pricing, it signals stress in the supply chain. Paper contracts can be settled in cash. Physical metal cannot be printed. And when dealers start hesitating to sell inventory, even at elevated prices, that's not normal behavior. That's defensive positioning. Business owners who survive on volume do not refuse sales unless they believe the replacement cost tomorrow will be dramatically higher than today. When the people closest to physical supply decide holding metal is safer than holding currency, something fundamental is shifting. Why this conflict is different, we've seen Middle East flare-ups before. But this situation carries three key differences. Timing, energy, choke points, inflation backdrop. Let's break that down. Timing global inflation is already elevated. Producer prices have been re-accelerating. Central banks are trapped between recession fears and sticky inflation. There is no easy policy response left. Cut rates during an oil shock that fuels inflation. Raise rates during war risk that crushes growth. Policymakers are cornered and markets know it. Energy choke points. Iran sits next to one of the most strategically critical waterways on Earth, the Strait of Hormuz. Roughly 1/5 of global oil supply flows through that narrow passage. Even the threat of disruption can spike crude prices instantly. And oil is not just gasoline, oil is transportation. Oil is food logistics. Oil is manufacturing. Oil is plastics. Oil is aviation. When oil jumps, everything jumps. History proves this. During the 1973 oil crisis, inflation surged into double digits. Equities collapsed. Gold multiplied. Energy shocks don't create mild inflation. They create system-wide cost spirals. The inflation base, unlike past conflicts, inflation today was already hot before missiles launched. That changes everything. If oil spikes into an already fragile system, central banks lose flexibility entirely. And when trust in policy control erodes, capital flows into hard assets. That's not theory. That's 5,000 years of monetary history. When uncertainty spikes, gold becomes neutral collateral. When currency confidence drops, silver becomes retail money. The 48-hour pressure build. Something most people don't think about. Markets close on weekends. Geopolitics does not. For the past 48 hours, investors worldwide have been watching escalation unfold without the ability to reposition. They can't hedge. They can't buy futures. They can't rotate portfolios. All they can do is wait, and that creates pressure. When exchanges reopen, that pressure releases all at once. That's when you see gaps. Not gradual moves, gaps. You go to bed with one price, you wake up to another, and gap openings during geopolitical shocks tend to be violent. What happens next? Three scenarios. Let's think logically, not emotionally. Scenario 1, contained, strike-limited retaliation. Symbolic response, back-channel diplomacy cools tensions. If this happens, gold likely stabilizes at elevated levels. Silver holds higher than pre-conflict pricing. Premiums compress gradually. Markets digest the event. This is the optimistic case. Even in this case, metals don't reset to previous lows. The floor has moved up. Scenario 2, escalation. Cycle retaliation triggers counter-retaliation. Oil tankers face risk. Insurance premiums spike. Energy markets surge. Inflation expectations jump. In this case, metals don't just rise, they accelerate. Gold tests new structural highs. Silver outperforms due to its smaller market size. Short sellers face pressure. Momentum builds on itself. This becomes a sustained repricing. Scenario 3. Regional war multiple fronts activate. Energy flow through Hormuz is disrupted. Oil spikes dramatically. Global supply chains seize. Central banks lose control of inflation expectations. This is the scenario where metals go vertical, not gradual appreciation. Vertical repricing. Because in a world where energy supply is uncertain and monetary credibility weakens, hard assets become lifeboats. Extreme events produce extreme price reactions. The paper versus physical divide. Here's something critical. The spot price you see online is largely driven by derivatives, futures contracts, dot options, leveraged exposure. But physical markets run on supply and demand in real time. When physical premiums widen sharply, that means immediate demand exceeds available supply at current pricing. If that spread persists, futures must eventually catch up. Paper cannot permanently suppress physical shortage. One side adjusts. Historically, it's the paper price, the margin. Call effect, there's another dynamic forming quietly. Short positions. Traders betting against metals during a rally. If markets gap up aggressively Monday, those shorts open deep underwater. Brokerage risk departments issue margin calls. Forced buying begins. Forced buying pushes price higher. Higher price triggers more margin calls. That cascade can become self-fueling. Silver, due to its smaller total market size, is particularly vulnerable to this kind of squeeze. And squeezes don't move politely. They move explosively. Why this moment feels different? Because this isn't just about war. It's about timing. It's about inflation already running hot. It's about supply chain fragility. It's about energy choke points. It's about central banks already out of room. This isn't a single catalyst. It's multiple stress fractures hitting at once. And when systems under tension take a shock, price discovery becomes violent. If you've been positioned in metals, this isn't luck. It's preparation. Precious metals aren't about hoping for crisis. They're about recognizing systemic risk before headlines confirm it. What we're witnessing right now is the collision of geopolitics and monetary fragility, and we're only at the beginning. Because what happens in the next 24 to 48 hours will determine whether this stabilizes or whether we enter the most aggressive metals repricing cycle of the modern era. Now, let's talk about Monday morning. Because what happens when markets reopen may be more important than the missiles themselves. Right now, billions of dollars are frozen in place. Portfolio managers, hedge funds, commodity desks, central banks, family offices. All of them are watching the same thing you're watching. Explosions, emergency alerts, oil futures moving in thin liquidity, digital gold surging while traditional exchanges sit closed, and they cannot act. That inability to act is building pressure. When markets are shut during a geopolitical shock, fear compounds in silence. There is no outlet, no hedging, no rebalancing. Then the bell rings and the pressure releases. That's when markets don't drift, they lurch. The institutional stampede. Let's think through how professionals operate. If you manage billions of dollars and a regional war threatens 20% of global oil supply, you don't wait for clarity. You hedge first. You ask questions later. That hedge historically means increasing gold exposure, increasing commodities exposure, reducing equity risk, reducing emerging market currency exposure, moving into defensive collateral, and when everyone reaches for the same hedge at the same time, liquidity disappears. Gold's market is large. Silver's market is tiny by comparison. It takes dramatically less capital to move silver 10% than it does gold 10%. That's why in crisis moments, silver often moves with leverage to gold. If gold gaps $200, silver doesn't move $2. It can move $8, $10, $15. Because the market depth isn't built to absorb panic positioning. The oil multiplier effect, now let's quantify the oil risk. Even without a full blockade, insurance premiums for oil tankers can spike overnight if military escalation threatens shipping lanes. That alone increases delivered oil cost. If crude jumps from, say, $85 to $140, here's what that means economically. Transportation costs surge. Airline fuel costs surge. Agricultural input costs surge. Manufacturing input costs surge. Consumer prices reaccelerate. Inflation expectations shift rapidly when energy moves aggressively, and inflation expectations are what drive gold, not today's CPI print, not last month's PPI. Expectations. If markets begin to believe inflation is about to re-accelerate because of supply shocks, gold reprices before the data confirms it. That's why metals often move ahead of headlines. They are forward-looking barometers of monetary stress, the Federal Reserve problem. Here's the structural issue. Central banks are already cornered. Growth is slowing. Debt levels are extreme. Government deficits are expanding. If oil spikes and inflation reignites, rate cuts become politically difficult. But if growth weakens simultaneously due to war risk, rate hikes are equally dangerous. This is policy paralysis, and when policy credibility weakens, trust shifts away from fiat systems and toward neutral stores of value. Gold doesn't require a promise. Silver doesn't require confidence in a central banker. That's why metals outperform during periods of policy confusion. And right now, policy confusion is not theoretical. It's active. China, the signal. Most people miss. Now let's zoom back to Asia. Because what's happening in Chinese physical markets is not noise, it's signal. When physical premiums rise significantly above international futures pricing, it tells you something important. Immediate demand is outpacing available supply at current prices. And when small dealers hesitate to release inventory even at elevated buyback prices, that tells you something even bigger. They expect replacement costs to be higher. In commodity markets, behavior often matters more than headlines. If the people closest to supply chains are defensive, you pay attention. China is the largest consumer of many industrial metals. It is deeply embedded in solar manufacturing, electronics, infrastructure build-out. Silver is not just money, it's industrial necessity. If buyers believe supply disruption is possible due to geopolitical instability, they secure inventory aggressively. That behavior creates feedback loops. Premiums widen. More buyers rush. Supply tightens. Futures markets catch up. That's how divergence resolves. The paper market stress point. Here's something rarely discussed publicly. Futures markets operate on leverage. For every ounce of physical metal, there can be multiple claims via paper contracts. That system works smoothly during calm periods, but during sudden demand spikes, delivery pressure increases. If enough participants demand physical settlement instead of cash settlement, strain appears. Now, I'm not suggesting immediate systemic failure, but I am saying that volatility amplifies fragility. And when volatility hits during geopolitical escalation, leverage systems feel it first. That's when margin calls cascade. The short squeeze. Scenario, imagine this. A trader shorted silver at $99, believing the rally was exhausted. Markets close Friday, war risk intensifies, silver opens Monday at $105. That trader is instantly underwater. Broker calls. Additional capital required, or position closed. Forced buying begins. Multiply that by hundreds of leveraged funds. Now you have mechanical demand, not emotional demand. Mechanical demand is powerful because it doesn't negotiate, it executes. In thin liquidity conditions, that's when price teleports, not climbs, teleports. And once momentum traders detect acceleration, they pile in. Momentum on top of forced covering can create historic daily candles. That's not hyperbole, that's how commodity squeezes function. The gold to silver ratio. Compression. Another dynamic to watch is the gold to silver ratio. In stable environments, gold often leads. In high volatility monetary crises, silver tends to outperform once momentum confirms. Why? Because silver is both monetary and industrial. When inflation expectations rise and investor demand surges simultaneously, silver benefits from two forces. If gold pushes to new highs and silver lags initially, the ratio compresses rapidly during catch-up phases. Historically, rapid ratio compression coincides with explosive silver moves. That's not guaranteed. But in a war-driven inflation shock, it becomes statistically more probable. Retail psychology. Let's talk about human behavior. When gold makes headlines for sharp gains, mainstream media coverage increases. When silver crosses psychological levels, retail attention explodes. Search volume spikes. Coin dealers report surges. Online bullion inventories thin out. We've seen this pattern before during crisis spikes. The difference this time? Digital communication spreads fear faster than ever. And retail flows, when aligned with institutional hedging, amplify trends rather than fade them. That alignment is rare, but when it happens, price discovery accelerates dramatically. The three paths forward, refined. Let's refine our earlier scenarios. Contained escalation markets gap up. Volatility remains elevated but manageable. Metals hold higher plateau levels. Oil stabilizes below extreme levels. This creates a new structural floor. Sustained escalation, oil remains elevated. Insurance premiums remain high. Retaliatory cycles continue intermittently. Metals grind upward in waves. Each headline creates a new leg. This is a stair-step bull phase. Regional supply shock shipping lanes disrupted. Energy spikes sharply. Inflation expectations de-anchor. Metals enter price discovery mode. In this environment, historical resistance levels lose relevance because markets stop pricing quarterly earnings. They start pricing systemic risk. The bigger picture step. Back, this isn't just about one weekend. This is about structural fragility, meeting geopolitical ignition. High debt, elevated inflation, energy, choke points, policy constraints, supply chain vulnerability. These conditions were already present. The conflict is an accelerant. Metals are not reacting to one headline. They are reacting to stacked risk. That's why moves feel larger than normal, because they are repricing cumulative stress. Final thoughts for holders. If you hold metals, remember why. Not for celebration during war, not for excitement over volatility, but for insulation during instability. Precious metals historically function as monetary shock absorbers. They are not growth stocks. They are protection instruments, and protection becomes most valuable when uncertainty peaks. Right now, markets are standing at a crossroads. The next 24 to 72 hours will determine trajectory, contained event, or systemic escalation. But one thing is already clear. The complacency phase is over. The world has shifted from theoretical risk to active instability, and markets reprice that shift fast, very fast. If escalation continues, we are not looking at a normal commodity rally. We are looking at a volatility regime change, and regime changes are remembered for decades. Stay alert, stay rational. And understand this. When geopolitics collides with monetary fragility, hard assets stop being optional. They become strategic.